So, you think you know where money comes from. You're probably picturing a giant government printing press, right? Well, what if I told you that most of the money in our economy is actually created out of thin air by the very banks you use every single day? Today, we're going to pull back the curtain and see how this magic trick really works. Okay, let's dive right in with a question that gets to the heart of all of this. You know your bank. You've got the app, maybe you visit a branch, but when your bank needs a bank, who did they turn to? The answer to that question, well, it pretty much explains the entire structure of our economy. And that's because our whole system runs on two totally different kinds of banks. On one side, you've got your commercial bank. That's the one you know. Its goal is pretty simple: serve you and make a profit. But on the other side, you've got the central bank. It doesn't serve you, it serves the commercial banks. And its goal isn't profit. It's making sure the entire economy stays stable and healthy. It's the ultimate referee. So our financial world really has these two main players. To get the full picture, let's start with the one we're all familiar with, your everyday commercial bank. Yep, this is the bank on your high street, the name on your debit card. At its core, it's a business, and like any business, it's designed to make money. It does that by taking your deposits and then lending them out for a higher interest rate. Simple enough on the surface, right? But its real power, its true role in the economy, lies in something else entirely. See, just making a little bit of money from interest rates, that's only part of the story. So what is the real business of your bank? How do its day-to-day operations actually shape the whole economy? Okay, so it starts with the two things we all get. They accept our deposits for safekeeping, and they advance loans to others. But it's this third thing, creating credit, that's the real game changer. Through the simple act of lending, banks perform a kind of financial magic. They actually create new money. This ability to just create money is without a doubt the most important thing commercial banks do. It is the engine of our modern economy. So let's break down exactly how it works, step by step. It all starts with one simple deposit. Let's just imagine someone walks into Bank A and deposits 1,000 rupees. That's our seed money. Now, here's the first rule of the game. A bank can't just lend out every single rupee it gets. The central bank, the referee, remember, sets a rule called the cash reserve ratio, or CRR. It's a tiny percentage of all deposits that the bank must hold on to. It's a safety buffer. So let's say the CRR is 20%. That means Bank A has to keep 200 of those rupees in reserve. But, and here's the magic ingredient, it can lend out the other 800. And that one single act of making an 800 rupee loan is the moment new money starts to be born. So, follow the money here. Bank A loans out that 800 rupees. The borrower immediately uses it to buy something, maybe a new laptop. The person who sold the laptop then takes that 800 rupees and deposits it into their bank. Let's call it Bank B. Now, for Bank B, that 800 rupees is a brand new deposit. So what do? They keep 20%, that's 160 rupees, and they lend out the other 640. And that 640 is then spent, deposited in Bank C, and the whole cycle just keeps on going. And here's where you see that chain reaction in full effect. Our first 1,000 rupee deposit created an 800 rupee loan. That loan became a new deposit, which created a 640 rupee loan, and on it goes. Now look at those totals. That single initial 1,000 rupee deposit has multiplied again and again, creating a grand total of 5,000 rupees in the system. The banking system literally created 4,000 new rupees out of thin air. Now, this is obviously an incredibly powerful process. But it also sounds a little risky, right? If commercial banks can just create money like this, what stops them from going crazy and crashing the entire economy? Well, that's where the central bank comes in. This is the big one. It's the institution at the very top, the banker's bank, and the ultimate guardian of the whole financial system. Its number one job is to keep everything stable. And it does this by playing a few key roles. Sure, it's the only one that can print physical cash. But in our story, its real power comes from two other jobs: being the banker's bank, where it holds those reserves, and most importantly, being the controller of credit. It's the one that manages that whole system of money creation we just talked about. So if the commercial banks are the ones actually creating all this new money, how exactly does the central bank keep them in check? What are the actual levers it can pull to control the flow of money through the economy? Well, it has this powerful set of tools that basically act like the gas and brake pedals for the entire economy. By tweaking them, it can either encourage banks to create more money and get things growing, or it can force them to slow everything down to fight off inflation. Okay,
Two of its biggest tools are the repo and reverse repo rates. The repo rate, that's the gas pedal. It's the interest rate that commercial banks have to pay to borrow from the central bank. If the central bank raises this rate, it gets more expensive for your bank to borrow, so they'll lend less. The reverse repo rate is the brake. It's the interest banks get for just parking their extra cash with the central bank, which also pulls money out of the system.
And then you've got the reserve requirements, which directly limit that money magic we saw. We already know the CRR, the cash they have to park with the central bank. But there's also the SLR, which is a percentage of assets they have to keep with themselves in safe stuff like cash or gold. By raising either of these, the central bank directly shrinks the amount of money a commercial bank is even allowed to create from each deposit.
Look, I know this can all seem like some really high-level, abstract finance stuff, but these policies have a very real, very direct impact on your wallet and your daily life.
It all boils down to this super simple chain reaction. The central bank changes its policies. That changes how much money costs for your bank. And then your bank passes that cost directly onto you in the form of the interest rates you pay for your loans.
And this affects pretty much everything. So when you hear on the news that the central bank has hiked rates, it usually means that the interest on that car loan or mortgage you were thinking about just got higher. It can also change how much you earn on your savings account. At the end of the day, these are the tools used to manage the big picture, to fight inflation or boost a slow economy, which, of course, affects jobs, prices, and your overall financial well-being. So there you have it, the two-tiered system. A big central bank watching over a network of commercial banks that create most of our money simply by issuing loans. But understanding this leaves us with a huge final question. If our entire economy is built on this cycle of creating new money from debt, what happens to the whole system when we can't pay that debt back? And that is something to think about.